Hi, from me, Sigmund again. I'm going to admit something to you, that before I did these logic models and before I designed them, I came across this academic exercise in my financial studies, and it was called an exercise on the accounting equation. And people spoke to me about it. Do you know your accounting equation? Do you know the effects of the accounting equation? And I used to look at it and I used to say, yes, I do. It's assets is equal to equity plus liability. So if I buy something and I increase my assets, I either have to fund it from within my assets, like cash, so I have to give cash away, or else it affects my liability side. Yes, it does, but it does more than that. You see, once you've understood this equation properly, and you've got the insights that the logic models gives you, you're going to understand how the accounting equation helps you make a decision going forward. Now notice what I'm saying, how the accounting equation helps you make a decision for your business going forward. I'm not saying how the financial statements help me make that decision. And how does this work? Well, here's a scenario. My procurement officer came to me and said, we can save 10% on the cost of our raw materials if we buy 6 months worth of product. What advice must I give that procurement officer? What advice would you give them? Well, with the insight I got from the accounting equation, I was able to easily identify what advice to give him. Why was it? Well, I looked at the accounting equation and said, okay, I'm going to affect my net asset value part, this bottom section of the logic model. So I'm going to affect that. And I've got one of two ways to affect that. I'm going to increase my raw materials or my inventory here, or I'm going to increase my finished goods that I'm going to have ready for the marketplace. So I'm going to increase that by spending more up front. Now, if I have the money lying in my cash reservoir, then I'm changing the shape of my assets. So I'm changing cash for raw materials. And if I don't have to borrow anything further, then I'm going to help the business, because I'm basically merely going to change the shape of my net asset value. I'm not going to change the value, and in doing so, I'm going to bolster one of my pillars within my business, the pillar on costs. I'm going to make those costs more efficient. So if I don't need to borrow capital and it's not going to cost me interest, I'm going to change the shape of my net asset value. And that's all. I'm not going to change my owner's equity, so I'm not going to change what I own, and I'm not going to change what I owe third-party liabilities. I'm therefore also not going to change my gearing. So none of that's going to change, but I'm going to improve my profitability. Well, does that decision now become self-explanatory? And would I do that? Yes, I would do that. If, on the other hand, I have to get that raw material from a supplier on credit, now the position changes slightly. If that supply is purely on the cost of the goods and I don't have to pay interest on it, and I've got sufficient money to keep the solvency going, then it's very easy. I'll let that supplier supply me. And again, what am I affecting? I'm affecting the pillar of costs. I'm making my costs more efficient. Am I changing my assets? No, I'm keeping my net asset value the same, so I'm keeping that in control. Am I changing my gearing? No, I'm not changing my gearing. So that pillar is in control. And do I affect the tax? For this purposes, let's ignore tax. So it's a no-brainer to take that decision. However, if I have to borrow capital from my long-term capital suppliers, then either it's owner's equity, so I'm going to have to raise owner's equity, or I'm going to have to raise liabilities, my long-term liabilities. And if I have to raise my long-term liabilities, there's interest going to come with it. So now I must play the cost saving that I'm going to make through this procurement against the interest expense I'm going to have. So on the one hand, I'm going to reduce my costs, I'm improving that pillar, but on the other hand, I'm increasing my costs on interest, so I'm affecting that pillar. And now the sums are easy. Is that effect higher than the saving? No brainer again. Let's say the two are equal. And let's say I'm going to change my gearing though. So my gearing, the amount that I have invested in the business against what I owe to third parties. If I affect that negatively, what is the longer term effect? Now I've got to ask the question, am I going to be looking at raising capital? Because if I'm looking at raising capital, then I don't want to weaken my gearing. In other words, I don't want to become more geared. If on the other hand, I'm saying I don't need to go and raise more capital, and I am in a very profitable situation in this company, at the moment I am making a lot of money, then I want to make that money with other people's money. So if my profitability, my GPs are very good, then I want to utilize gearing to help me make more money for me as the owner. This insight I only got once I had understood this accounting equation properly. And unfortunately, it came many years after my academic learning of the accounting equation. My understanding of the accounting equation is it was an exam test, and I had to get the right answer for that exam test because I needed those points in order to qualify. I'm being honest, and I'm sharing my real life situation in this. This balance sheet logic model gave me this insight. Now, in a similar way, I can play the following example. I discussed with you what happens when procurement comes and says, can we buy more material? Now, here's the other question. The sales guys come in and they say, we can sell more if we drop the price. Now, what's your knee-jerk answer to that? Well, accounting equation-wise, I'm going to affect the pillar of my profitability. In other words, my costs in relationship to my turnover is going to change. So I'm giving away profit. And because I'm giving away profit, I'm losing money. Now, do those additional sales surmount to an amount that's worth more than that loss in profits? Because if they do, if I'm going to sell twice the volume and I'm going to make twice the profit in volume terms, then again it's a no-brainer. But let me sit and say this. Let us say that it's going to move my inventory from here into my debtors reservoir, and it's going to lie there for 2 months because the customer said they would buy more if they can get longer terms. Now the question changes slightly, but I can still answer it from the insights given to me by this balance sheet logic model. Why? If my inventory is not moving, I need to get it through this cash conversion cycle. And you can see it needs to get through. And if it's getting stuck here in either the work in process or the finished goods area, and by giving the customer better terms, I'm going to get that inventory into that area. And I'm not going to affect my working capital per se. I'm not going to require more cash inflow to do that move. Then it is a no-brainer because I'm moving it up the cycle. My net asset value is going to be the same. I'm going to increase my debtor, but I'm going to decrease my inventory. My net asset value is equal. It's still in the same boat. If, however, I have to get more capital in, well, where am I going to get it from? Am I going to get it from owner and the owner equity by investing more, either via loan, or am I going to get it from third parties with loan investment? And then I've got to sit and say, well, if I'm going to get it from third parties, is that got an interest element to it? And is that interest more than the additional profits I'm going to make? If that interest is more than the additional profits I'm going to make, then I've got to ask myself, what am I achieving? Am I getting a flow through my solvency ratios? In other words, getting the goods out the door and trying to drop the stock that's stuck in here, or the inventory that's stuck in these reservoirs? Or am I increasing the market share? Now, these pictures became clear to me once I understood the working capital logic model. Once I understood where capital employed fitted into the employment of the capital. And then when I looked forward in the business, I could look and say, am I improving my net asset value? And if I'm improving my net asset value without incurring further long-term liabilities, I must be improving my owner's equity. It's as simple as that. If I'm improving my cost efficiencies and I'm utilizing third party, I need to ensure that I am in a very profitable situation. So I'm utilizing long-term third party. I need to ensure that I am in a very profitable situation. If I'm in a very marginal profit situation, then it means that that interest charge that third party is going to give me from long-term liabilities, it's going to cost me more. And therefore, I shouldn't be making this decision. So much easier to understand from this aspect than from the theoretical asset equals equity plus liabilities.